15 seconds.
About them, just from here.
Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me on the desk at MarketSite, we have Maddie Radner, Director on Nasdaq's Market Intelligence Desk. We'll also be bringing in Joyce, Managing Director on Nasdaq's Market Intelligence Desk, for a technical read on the charts. Before we get into that, Maddie, let's talk about the momentum. The key question, of course, there's some chop in the market today, is market breadth improving? Can the momentum continue? Because, by the way, not only did the Mag 7 have a great quarter, but if you remove that, the 493 other S&P 500 stocks, they returned an average of 8%. That's not bad for one quarter.
Yeah, thanks for having us back, Jill. So I think in the first half of last year, there was definitely widespread concern about the concentration in the market, and any gains we did see were really concentrated in the Mag 7, in those large cap tech stocks. And so far this year, that breadth has definitely improved a little bit as we focus on the Mag 7. They accounted for 60% of the total return of the S&P 500 last year. This year, they're only accounting for about 36%. So hopefully that means there's a broader participation. We are seeing that across some of our broader indices, such as the Russell 2000 Mid-Cap Index. We're also seeing cyclical areas such as housing and manufacturing tick up a bit, so it's looking pretty good.
Yeah, I mean, we were talking about that in one of our formal panels, where since people aren't able to move because of the supply issues in the housing market, you're starting to see either new home builders or the DIY names like Home Depot as an example, do well because of that. So it is moving into other areas, and it does give us something else to talk about besides tech. Let's bring Brian in here. Let's get a technical read on the charts here, Brian, as we look at market breadth improving over the broader market.
Yeah, so market breadth. So we're looking here at the S&P 500 and below. It's the advanced decline line, and I've less in the camp of being critical about the breadth. I think the breadth has been improving since last summer, and it started with the large caps here. We can see the advanced decline line broke out to new highs in June and July of 23. It pulled back in the fall, as did the S&P 500 index, but it was a good leading indicator where breadth, in this case, the advances versus decliners, was making new highs before the index, and now we can see the index, is well into new high territory, just like the S&P 500. Now we circle back to the present time, we can see a number of indices making new all-time highs that would confirm the breadth is very good. The S&P 500 equal weight index right here. Here we have, as Maddie noted before, the S&P Mid-Cap 400 is at all-time new highs, and even the Mid-Cap Value Index is now making all-time highs. So where we thought, the market were being driven largely by the large cap growth, that's really just no longer the case right now. And even the Russell 2000, which certainly is underperforming and continues to underperform over the longer term and the very near term. In the fourth quarter in December, we saw the number of 52-week highs within that index really hit its highest level since 2001. So the breadth there is getting well. And we also spoke previously about how another breadth measure, the price of the index versus its 50-day moving average, in this case for the Russell 2000, really hit extreme levels in mid-December. And if you go back in time when they've been that wide in the past, it's happened a lot of times, about 46 times previously is the sample going back to the late 1970s. But the majority of those, like 90%, took place in very early stages of a new bull market move for this index. So I think history is on the side here as far as breadth is concerned. It just continues to improve over the intermediate and longer term.
Yeah, certainly gives us something more to talk about. But Maddie, let's talk about your small caps for a moment here. I mean, the dispersion in performance is quite glaring. What can you tell us about there?
So at the beginning of the week, we were definitely hearing from a lot of our small cap companies on the market intelligence desk. They were under a bit of pressure Monday and Tuesday, just as kind of the uncertainty on rate cuts were trickling back in. I think the stickier inflation, uncertainty about job data, as well as kind of uncertainty about yesterday's Fed speak was coming in. So pressure on small caps came back into the picture, and it really just comes down to rates.
Right.
We're in a higher rate environment. It's very hard for small caps. Small cap pays variable, so they're essentially paying more interest than everyone else. I saw somewhere that 45% of Russell 2000 companies have floating rate debt, excluding financials, compared to only 9% of the S&P 500 index. So they're really relying on these rate cuts to come.
Yeah, and they have been upticking. Plus, the cost of capital is something that smaller cap stocks are sensitive to, right? So then you have these variable rates. They've only been going up, right?
Yep.
And I mean, that was probably why they had that move in December, because market was pricing in 6 rate cuts.
Yep.
And
It's now,
that would have been good
yep.
for them.
That moved down to 3, which was still good for them.
Right.
But then the timing, so June went from 70 to 60 at the beginning of this week. So that's what maybe spooked investors a little bit.
Right, right. And also, they don't tend to have as much cash on their balance sheets. They're typically more debt heavy than, let's call it, a large cap growth stock like an Apple, which has billions of dollars on its balance sheet, and not quite as debt heavy. So that's another reason too why, I mean, it's not just about rates, it's also, you know, what the overall business looks like.
Yeah, and I think on top of that, yesterday you had a panel of experts kind of talk about that they are still maybe attractive as M&A targets, that they're so discounted that maybe they should be continue to be an opportunity through the rest of this year. I noticed that there was a lot of talk about small cap biotech, and I've been noticing that. We cover that a lot on the space. There's a lot of biotech listings on Nasdaq. I noticed that there's 25 targets that have already been acquired or will be acquired in 2024 in that space. They're being acquired by large established firms such as Amgen, AbbVie, Sanofi. So there's a lot of opportunity there.
Yeah, and it's certainly less expensive than trying to grow that technology organically as well. All right, Brian, back in with you. What you say about small caps? Anything else you can, or maybe even pull up something on biotechs, to Maddie's point.
Yeah, so I certainly agree. In the first quarter of this year, we saw the pendulum swing back towards large caps outperforming, as well as mid caps. Here we're looking at the Q1 total returns of the S&P 500, the Nasdaq 100, and the mid cap index, which are between 9 and 11%, whereas the Russell 2000 and the micro caps were around 5%. So, but if you look at, say, the last 5 months, we could see that even including the first quarter where the smaller caps underperformed, if you go back and look at an aggregate of the prior 5 months ending Q3, so from November through the end of March, we can see over that longer term time period, micro caps, mid caps, and small caps all outperformed the Nasdaq 100 and the S&P 500. So the more recent underperformance of the smaller group, as Maddie was saying, makes perfect sense when you had a repricing of the hawkishness that we're looking for regarding interest rates, and but at the end of the day, I believe the market is confident that interest rates are coming down the pipeline, and even though the small caps are underperforming, we can see here in the Russell 2000 they are beginning to break out to new highs. So we broke out of this range in December, which is about an 18 to 20 month trading range, and then back by we had the pullback in January, and then in February and March we've been higher. And the first quarter performance 5%, that's not too bad on an absolute basis. Relative to what the Mag 7 is doing, the Nasdaq 100, yeah, sure, it's underperforming, but on an absolute basis, I think it's looking looking pretty good. And here we have the Nasdaq Biotech Index, and we can see it's recently been pulling back as markets become increasingly uncertain as to whether or not that rate cut cycle will begin in June. But look at where we are. So this low here back in February for the Biotech Index, and this low here today, it's really, what it's touching on is, a top right here, very minor top in mid-December, but go back here to March, April, May, and June, that was clearly defined resistance. So technically you could expect prior resistance, you at least hope for bull's case, prior resistance back here in the spring and summer of 23 is now acting as support. So time will tell whether or not that will be the case. And I think that will largely be dependent on the near-term economic data. We have jobs on Friday, CPI, PPI next week, and so we'll see how that plays out. Yeah,
and Maddie, of course, tomorrow is the key number because employment data, especially wage growth, has been coming in pretty hot. So I think this is going to be, an extra special watched number tomorrow. Yeah, we've been seeing the market go back and forth all day as different experts comment on tomorrow's numbers, expectations. So I think investors are really looking for a Goldilocks number, one that won't give any Fed the reason to dial back rate cuts, but also won't suggest that the market is in a serious downturn in terms of employment. So all eyes are on tomorrow's number. As Brian noted,
A few other upcoming catalysts would be CPI, and then we're already getting into Q1 earnings with banks reporting
which
next
will
week.
be refreshing because I feel like every time we're in this earnings vacuum, all we do is hyper-focus on what's happening in the macro. And I guess you have to ask yourself, is it a glass half full situation where if the economy is doing well, people are employed, the consumer's still spending because they do have jobs, it's a tight labor market, is that better relative to just a rate cut? So we'll have to see what happens there. Brian, so if the NFP number comes in hot tomorrow, right? I'd expect that you'll see some fireworks in the 2 and 10 year.
Yes, certainly, the economic data has been impactful to rates, and that's really, where there's always such a big focus on. So, the common 2-year and the 10-year yields is what you hear a lot of reporting about. And so here's the 2-year Treasury yield. And even though the economic data since really the beginning of March, when that payroll number came out, semiconductors spiked right at that point in time. The growth index relative to the S&P 500 hit its peak as well. But the 2-year yield peaked back in late February at 4.75%. It's retested that level a number of times. It coincides with the yellow line here, which is the 200-day moving average. But we can see now over the last 2 months, the short yield here has proven, was telling us that 475 is a key level. This, over the last 3 days, has actually been moving lower, despite the the economic data, which has it's been mixed. It hasn't all been hotter than expected. But so that's something to keep in mind here, is that as when you read the headlines, you think interest rates are going higher over the last month or so. Not in the 2-year yield. It made its high back in late February. When we flip over to the 10-year yield, we can see very similar readings. So whereas the 2-year yield, this is about a 6-week trading range right here for the 10-year yield. This is about an 8-week trading range where its resistance has been around this 4.35% level. We did get above it yesterday and the day before, but now we're back down below it again. And this is, looking over the last 8 weeks or so, we're seeing that resistance level. That's a key level, 4.35%. I bring it up because if you look at the longer term weekly period chart, this is 4.3, 4.35, this horizontal, red line here. This was the high going back into 2022 after this strong uptrend for this index where it started down around 1% and ran up to 4.35% in 18 months time. And so from there, it took about 11 or 12 months before the index eventually broke above that 4.35% level. So we've been testing it now again for 8 weeks. I think that's the key level in the near term to watch. If Friday's number is hot, the jobs number are very strong, very positive for the consumers and employment, we'll certainly expect a move higher in rates, and maybe we get above these resistance levels. However, I would then be focused on what's going to happen next week. If these breakouts higher in yields that could come on a stronger jobs number, will those breakouts hold, or will next week's data for CPI and PPI, if dovish, lead them to reverse sharply lower? And that would be something to note and catch a lot of people off guard. So that's something that I'm looking out for.
Yeah. Kind of the perfect storm there, right? When you think about all the variables and exactly, where the chart shows how it's at a very vulnerable point to go either to the up or downside. All right, Brian, appreciate the insight as always. Thanks for joining us on Trade Talks. Maddie, thanks for joining us on the desk. And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.